While the breadth of earnings beats may be wide, the leadership in the market is not. In fact, it is the narrowest stock leadership in an up market since the 1990s. Year to date, the S&P is up about 8%, but just 28 stocks account for 7% of that gain. 6 names account for 53% of that performance. Should that make investors worried? Let's bring in Mark Lehmann, CEO of JMP Securities, a Citizens company. Mark, it is narrow leadership in terms of what's fueling this price action. What does that say to you?
Well, there's no question, Sarah. You're right. There's definitely been a narrowing of the leadership, and there's been a flight to quality and a flight to size. The moves are historic, what we saw in some of the biggest tech names through this year. And I think it shows more fear and I think a little complacency in terms of the investors. But let's remember, these companies are also on the forefront of innovation, particularly in technology, the likes of which we haven't seen in a long time. So we're just getting a glimpse of what that means for AI and the chat GPTs of the world. And I think that will fuel another interest in these stocks, and that will widen over time.
So I know you're a big growth guy. You've always liked the mega cap stocks. Which is your favorite in terms of positioning and setup into earnings this week?
Well, they're not reporting this week, but we've liked Meta here for some time now. I mean, I think they're getting their cost structure in line. It's so quick in terms of their pivots towards something and away from other things. So we've seen them, obviously, with what they've done with all in on the metaverse. And frankly, we haven't heard a lot of that lately. We've heard more about their plans with AI and some of the other things. SAP is a name, a big cap name that we don't hear a lot about. But you talk about a stealth bull market. We've been recommending that stock. My analyst, Pat Walravens, has been recommending that stock for some time now. And they are on a huge growth trajectory. They've got a great move to the cloud. They're rationalizing their balance sheet with the sale of Qualtrics, which will provide them almost $10 billion of cash. And they have a CFO who's all about delivering shareholder value. So it's a few names that, one that we all hear about every day and one that just has stealthily gone up a great deal. And we really like those names here going forward.
Yeah, that's one reason why a lot of the, at least the macro strategists are saying you got to wait to see what ServiceNow and Microsoft say this week. There was some discussion, Mark, yesterday about cracks in some legacy tech, and they pointed to F5, Seagate, CDW, ASML, even threw Tesla in there and some autos. I wonder if that's the budding sense that there are some fissures, at least in legacy technology growth.
I mean, Carl, that's very fair. I mean, we're about to embark on a technology ramp, I think that, frankly, most people are not prepared for, and the winners of which probably have not been written today. There's an old line, one of my mentors in the business, George Vanderheiden from Fidelity, used to say, being right and being early is the same thing as being wrong. And there's some companies that are going to be right here and maybe be early in that second generation. I mean, look at Facebook, for example, Meta. We had the MySpaces and all the Friendster and all these things before, but it took kind of a 6th or 7th iteration for us to get with Facebook. This move in the AI world is so profound that I think who's the leaders deciding that today is probably a mistake. And I think we talk a little bit about the economy and what that means for inflation and deflation, et cetera. The ramifications are so vast for our employee force and for the workforce going forward, and the deflationary aspects of this are so vast. I don't think we begin to understand where that is. And if you're not innovating with the times, you're falling behind.